pull up the NASDAQ 100, the E-minis here, and I think that, we have a little chart. It's showing that uptrend from the January lows. To your point, Guy, about these stocks being able to sell off kind of quickly from the early February highs, the E-minis, the NASDAQ 100 here, they were just about 13,000. It got just below its 200-day moving average, right? If you look at that below 12,000, right? And then we rocketed back up. We made a brief new high. Carter actually made a great point about the NASDAQ 100 yesterday. He said the problem is those August highs here. You know what I mean? Because we had a bit of a blow off here, and he doesn't, that to him, the fact that we stalled out at those February highs is pretty bearish. And so if you look at that little uptrend that we've drawn, you look at where the 100-day is, and it's about to converge with this 200-day moving average just below 12,000. I mean, to me, I think there's a trade here in the NASDAQ, in the 100 E-mini futures here. So we're right here about 12,700. I would look, if I were to put a short on in the futures, I'd look to stop it just at about 13,000. Okay, so that's about 300 points higher here. But my initial target is down there at 12,000. So if we want to toggle back and forth here a little bit to that 1-year chart, my first target is that 200-day moving average. Okay. And then I think if we break that uptrend and we break the 200 and the 100, then I'm kind of going for 11,000, guys. So I want to keep a really tight stop on this. I'll try it again. But if it starts going in my direction, and this is a really important part about trading futures here, you want to continue to lower those stops, right? Because every time you lower the stop, you're basically locking in a percentage of that gain that you've already achieved there. And that's one of the reasons why trading futures and really liquid like markets like the NASDAQ 100 are really, you really risk manage them. So talk to me, Guy. You traded futures, you traded in commodities over the years, for years. Talk to me a little bit about this specific strategy and how you would look to kind of manage with moving your stops around.
I love your use of toggle, by the way. So here's this. Take a look at it. So you're selling right here, 12,700. Your stop is 13,000. So this is sort of a 2-to-1 in terms of risk reward, roughly. But to your point, now toggle back and think about what you just said. If this starts to work for you, that 13,000 stop gets lowered. We call that in the business a trailing stop. So if that 12,700 sale, if now we're trading, let's say 12,200, you can lower that stop effectively to your entry point. So now you're basically in it effectively for free. Now, to your other point, there can be a situation where you're right and it starts to accelerate. So you continue to lower that stop, but you can add to your existing short position. So you actually can sell on weakness. You can add to a short position on weakness. And that's sort of higher level shit, but that's what futures allow you to do. So if I'm looking at this, here's my entry point. My initial stop is 13,000. Things start to work in my favor. A couple days from now, that 12,700 entry point, we're now trading 12.4. I lower my stop. I lower that stop from 13 to 12.7. Now we break through that uptrend line. You know what? I add to my short position and I lower my stop again. Now people will say at a certain point, when you lower the stops, this trailing stop, it's going to get triggered. Yes, it will. Absolutely. But there are also situations where you could take profits theoretically at much lower levels and that trailing stop never comes into play. But as a trader, Dan, I think that's how you have to think about these things. That was pretty good explanation by me, by the way.
That was great.